Well, it's Michael Douville and Charles Nenner and I did a video yesterday, December 8th. We talked about the economy, we talked about equities, we talked about bonds, we even talked about Bitcoin and cryptocurrencies, and we talked about my asset class, real estate. So today I want to clarify some things and let's talk about what's going on in my asset class. Let's talk about those of us who have portfolios and maybe those who are just starting out. What should we do? So let's go to my very first slide and let's start talking about this. Now, my timing model has been telling us for years and years and years that we do have a little bit of time going on, and that time is starting to shrink. So I think we're in cycle completion. Now, it's a process, but it's started. So it's probably started in March. It is a pretty long process, but I think we're going to start seeing major problems in the real estate industry by the time we get to maybe the second quarter of 2024. So that's not very far away. That's 4 or 5 months away. So we have some time to change our portfolio. And let's talk about whether or not this is something you want to do or something you don't want to do. But it certainly looks like we're peaking. So let me go to my very first slide and let's talk about it. Now, we all know why. We have an extremely aggressive Federal Reserve. Now, they've been supporting business, but now they're no longer supporting business and they're withdrawing liquidity. $90 billion of liquidity a month. That's over $1 trillion in a year. And it's the most they've ever withdrawn ever, like never happened before. Now, you know that business and the economy and the stock market and real estate and most of the asset markets, we live on liquidity. You start taking liquidity away and our businesses start to falter, we're not going to be any different. This is not going to be different this time. So don't let anyone fool you. This is certainly going to affect us, and we're going to need to know what to do. We're going to have to think this through. You are welcome to reach me. I would highly suggest that you take a look at Dr. Nenner and my interview yesterday. That's December 8th, 2022, and review what we had to say. Also, while I have you, if you could subscribe or you can like these videos, YouTube really likes you to have these things. Their algorithms go crazy if you have that. So help me out with that. We appreciate it. We try to bring this content. And if you would like, you have comments. We got comments on our video that we weren't talking enough about cryptocurrency and Bitcoin. We brought you a segment. So if you send that to us, we'll try and accommodate it as best we can. So let me go to my next slide here and let's talk about that. And we'll see exactly what's going on. Now, everyone knows what happened with the 10-year and the interest rates. So March 9th, 2020 was the bottom for treasuries, 0.54% for a 10-year treasury. Who on earth would buy a treasury with a 0.54% yield? Wouldn't happen in my world, but someone did, and that was bottom. And I'm going to tell you, since then, we've had an aggressive Fed. They've been raising interest rates. And October 24th, they went to a high of 4.24%. And it has since backed off. Now, if you follow Dr. Nenner's work, you'll see that he forecasts this, and it's going right along to what he has said. But you have to ask yourself, why is the long-term interest rate coming down when we still have a rather strong inflation? And I'm going to tell you the bond market is forecasting, and they're 10 times the size of the stock market. So when they say something and they forecast, you'd better listen, is that the bond market is saying that we have a recession coming and it's going to be a bad one. So we've backed off about 0.75%. You can look into all the charts. You can see that a lot of the commodities have dropped. I mean, lumber peaked. Now remember these dates. It peaked in April at $1,424. And last week it was $395, so like a 70% reduction. It's since then come up a little bit, but nonetheless, it's way, way down from where it was. And when that happens, it's telling you that housing is going to be in trouble. And no one is using lumber, so you just need to pay attention. But that's what's going on in the economy, so we need to pay attention rather dramatically. So let's go back to these slides and see where we can go. Now, if you go into the Federal Reserve electronic data system, they have enormous amount of data, unbelievable amount of data. all kinds of things. Now, I went in, looked at the 10-year constant maturity minus the 2-year. That's kind of a benchmark. And we're looking at these inversions. And here's to my surprise. I wasn't looking for this, but I correlated when it inverted to the top of the housing market. And when this line crossed this zero mark, that signified the top of the real estate market in the last 3 or 4 or 5 markets. Now, we can go back to 1964, can't go much beyond that. But what I'm looking at every time that inverted yield crosses that zero line, that signifies top of the market. And it did it again. So we are completing. Now that means that the two peaks, now we don't get too technical, but when we show on our stylized, we show one peak, there's actually two. That first peak really is the one that has most of the momentum. That's where everybody is just clamoring to buy a property. That's when prices are going up, things are being bid, you get multiple bids, you get overpriced. That is already happened. That's in. On a typical cycle completion, we're going to see it come down a little bit. That exuberance just comes out of the marketplace. We've seen that. We've seen a discount of 10 to 15%, even here in Metro Phoenix. I think it's going to be worse across the country. And then the final peak, which is coming, and I'm assuming that's going to happen right after the first year, because I think we'll have a fairly good spring. That final peak may even go as high as the first peak, but probably not. And that signifies absolutely the bottom or the top. And you probably won't get much in the way of sales. So the first peak gets most of the sales, most of the momentum. By the time it gets to the second peak, all the air is coming out of the balloon and it's going to roll over and it's going to correct and probably correct pretty severely. So, and I have seen all kinds of pundits in the mainstream media saying, oh, well, the economy is softening up. Jerry Powell is going to go ahead and pivot. The Federal Reserve is going to reduce rates. I see absolutely no indication in any of my work, any of the things that I'm researching. I see no reason to think that the Federal Reserve is going to reduce rates. I don't see that happening. I think they're going to raise interest rates at their next meeting, which is like next week. And I think that they're going to continue. Now, they may pause, but I don't see them reducing rates. Actually, I think rates are going to go even higher. So I think we just need to prepare for that and just start getting our mindset that that's what is going to happen. Let me go to my next slide. We'll talk about that. Now, with this liquidity coming out, and I'm going to tell you it's affecting business, the Chicago Purchasers Manager Index came in at 37.2. It's almost historical. It's still declining. It may set a record, but it has never missed in the last 55 years, forecasting a recession. And the more it goes down, the worse the recession is going to be. Just like the stronger the inversion becomes, the greater that inversion, the worse the recession is. So we have a very, very bad inversion. It's going to get worse. And I think PMI is going to get worse. So prepare for a bad recession. Now, let me go to my next slide. Once this yield curve tops or crosses, it coincides with the tops. Now, it coincides with real estate tops. It coincides with the lumber top. It coincided with copper topping. And all of these things are very, very economically sensitive. So that's a very, very good indicator. And again, it's said that the Phoenix real estate market peaked. Now, we're not unusual across the country. We're just one of the better markets. We might even be the best market in the world. You know, we have so much in-migration coming here. The amount of employment that we're creating is just unbelievable. We have the Taiwan Semiconductors here. They're building 8 chip plants, and these are not entry-level jobs. These are really big, high-paying jobs. And we are just booming along that section as manufacturing industrials. Lots and lots of things are growing. We just got Sub-Zero and Wolf open a plant. So things are really doing well, but we have peaked. Prices are not going to go down, going to go up for a while. Maybe we get just a little bit, but we're not going to get those big appreciations. In fact, we probably are going to get a correction. Now, I don't see a collapse. I see a correction in the real estate market. I can always be wrong, but particularly here in Phoenix, we just have so much going on, and we have a shortage. not to be political, but we have all these people coming across the border. Where are they going to live? We have a housing shortage across the country. Where are they going to live? So let's look at the next slide. Now, in May 4th, when Dr. Nenner and I did a video, he said real estate doesn't look too good. It looks like 2006, and I think he's absolutely correct. I think we're going to correct. I think we're going to have a correction very similar to 2007, 8, 9, and 10. So it has the potential to be fairly severe. So what do we do when we have millions and millions and millions of dollars in our portfolio? So there's lots of good things. Even if the prices come down, it doesn't make any difference to us if you're not selling. Number one. Number two is we have huge cash flows coming in on our property. So if you sold your portfolio, those are going to go away. Now, if you sold your portfolio, we have tax consequences we have to be concerned with. And a lot of my investors and myself and my groups and the people I represent have really, really high capital gains that we've accumulated. Millions and millions of dollars of capital gains. They are subject to the capital gain tax, and anything we depreciated is subject to recapture. So it could go 20 to 25%, which is a pretty significant price to pay. So we really need to pay attention to what the tax consequences are. Plus, you've got vacancy. We have costs of sales. And you have to realize, what are we going to do with the money? If we find a better place, maybe it makes sense. But if it doesn't, maybe we need to hedge our portfolio. Because a lot of my clients and myself were reasonably high wage earners, and we get depreciation from our buildings. If you'd have bought a building here in Phoenix, we're just an entry level, you might have paid $350,000, $400,000 for it. Put on a depreciation schedule, you're going to get $12,000 to $15,000 a year in depreciation. What if you have 10 of them? Most of our clients have at least 10. So you're probably, as a high wage earner, if you have 10 and you're getting $15,000 a year in shelter, the first $150,000 that you make are tax-free. So how cool is that? Plus, we get cash flow. So you really have to think this through whether or not you want to sell your portfolio. Now, we have that opportunity coming to us for the next 3 or 4 months. I think we can do that. If you have excuse, you want to trim your portfolio, we can certainly do that. I'm really I held mine through 2008. I'm going to hold this now because I really like the income that comes in. But here's another idea. Let me go to this next slide and let's just talk about this. Dr. Nenner and I talked about this yesterday, and it makes a lot of sense. So we had talked about the fact that Lennar is on normal cycle. So Lennar and Toll Brothers, and they're publicly traded companies. Now, in talking to Dr. Nenner, he said, why don't you hedge your portfolio and you can take puts? Now, I would suggest you go talk to your financial advisor because these are publicly traded companies. If the economy and the building business slows down and their stocks start to drop, you can go short or you can take puts on them and earn a lot of money. And that will hedge your portfolio. So that will be a real estate hedge. You can do that. You can short some indexes. You can short the stocks. I suggest you go talk to your financial advisor and say, look, I'd like to hedge my portfolio. This way you'll make money on your hedge if your portfolio drops, and you'll maintain any wealth, and it'll certainly help maintain your wealth, and you'll keep a lot of cash. So just a very good way. The more you do this, but talk to your financial advisor and see if this isn't something that will work for you. It's just not for everybody, but it's just looking at integrated assets and using other asset classes to balance your real estate portfolio. It's just a brilliant, brilliant strategy for you. And you're welcome to call us. I'm more than happy to talk to your financial advisor. We can brainstorm, see if this works for you. We're here to help you. And you are welcome to reach me. Let me put my final slide up. So if you need to reach me, you can. I, of course, am with West USA here in Phoenix, Arizona. They're a $5 billion firm. They do all our back office work. They keep us in compliance. And should you want to talk with me, you can schedule something at 602-942-4200. I'm more than happy to talk with you. Please put in your subjects and comments that you'd like us to cover. Give us a thumbs up. Please subscribe. And if I can help in any way, please let us know. My very, very best to you. Bye-bye.